Did you know that real estate is the largest asset class in the world? According to a discussion during the World Economic Forum in December 2024, called Reimagining Real Estate, a Framework for the Future, the total market capitalization of global real estate has reached $379 trillion by the end of 2024, which is more than the equity and debt combined. If we consider some of the total market caps of those three major types of assets as the total assets in the world, then the real estate is taking 62%, followed by debt 21% and equity 16%. If we compare the market caps of those three major types of assets separately with the global GDP, then the real estate market cap to GDP ratio on global level is 375%. Debt to GDP ratio is 130%, and equity and the global GDP having roughly 1-to-1 ratio. While those data themselves does not make much interpretation, but I wanted to see how would the data look like on country level. So I searched through some public sources to find out the data on country level and made the similar analysis and compared those with the indicators in UAE. So let's check this out. So the general picture of UAE is like the real estate market cap in UAE is taking only 37% of the total assets in UAE. Equity is the largest asset class in UAE due to its abundant oil reserve. While when it comes to Dubai, after the COVID, the residential property price in Dubai has increased by 70% for the past 4 years and reached $208 billion. But the share of real estate as an asset from the total assets in Dubai is only 41%, which is way lower than the 62% of the global level. It seems a little bit higher than the UAE level, which makes sense because Dubai has the most developed real estate market in UAE and its economy does not rely on oil. Now let's look at some other countries. I have grouped these countries into global top 10 countries, European top 10 countries, Asian top 10 countries, and 11 countries in the Middle East. So from the profile of global top 10 countries, only in USA, the share of real estate as an asset from the total assets in USA is 40%, is lower than the global level of 62%. Maybe it's due to USA is having a higher level of debt and its equity market is very attractive. The real estate in Japan is same level as in global level of 62% from the total assets in Japan. While the remaining 8 countries from the global top 10 countries all having the higher shares than the global level for the real estate as an asset from the total assets in those countries. From the profile of Asian top 10 countries, only in Saudi Arabia and Malaysia have a lower level of distribution for the real estate as an asset in the total assets compared with the global level. 46% in Saudi Arabia and 57% in Malaysia. Real estate in China is taking 69% from the total assets in China. India 86%, Indonesia 88%, Vietnam 93%, and Turkey is being the highest level, having a 96% of their assets are in real estate. From the profile of European top 10 countries, the share of real estate as an asset from the total assets in those top 10 European countries all are higher than the global level of 62%, mostly ranging from 66% in UK and Belgium to 95% in Russia. The shares of real estate from the total assets in most of the top 10 European countries are around 70% to 80%. The top 3 countries in Europe with the highest share of real estate are Poland 83%, Germany 88%, and Russia 95%. Well, from the 11 countries in the Middle East, 3 separate groups can be identified in Middle Eastern countries. So group 1 are low real estate share countries. Those are Saudi Arabia, 46% are in real estate, but is a heavy equity country. UAE, 37% in real estate, is a heavy equity country. And Bahrain, 54% in real estate, is a heavy debt country. Group 2 are heavy real estate countries. Those are Lebanon, 92%, Jordan, 92%, Iraq, 89%, Kuwait, 83%, and Egypt, 81% of their assets are in real estate. Group 3 are heavy equity countries, but the share of real estate in those countries are higher than global level, but not that too high. Those are Qatar, 64%, Iran, 66%, and Oman, 76% of their assets are in real estate. Regarding the property price bubble, you might have seen a report by Swiss bank UBS about global real estate bubble index, showing that the bubble in Dubai is at moderate level. I would like to further confirm this by a simple ratio between the real estate market cap to GDP, but it's on country level and global level. Seems like more macro. So the real estate market cap to GDP ratio on global level is 375%, while this indicator in UAE is only 125%. The real estate market cap in India, Jordan, and Turkey are more than 10 times of their GDP. The highest level that I found is that the real estate market cap in Lebanon is more than 35 times of their GDP. So the wealthy individuals and the real estate investors from those countries which have real estate market cap is more than 7 times of their GDP should consider to invest in the countries that have those ratios are less than the global level. UAE real estate market might be the best choice because all of the data above indicates that in the long term there is still much more potential for the capital appreciation for the real estate price in UAE. Do you know why global asset managers and international institutional investors have stepped into real estate in UAE? For example, Brookfield from Canada, Mapletree from Singapore, Hillhouse Investment from China, Goldman Sachs from USA, Citigroup from China are all investing in real estate in UAE. Some people might think, does it make sense to allocate assets in UAE? Is it worth taking such risk? How would be the reward to risk? To find out the answers to those questions, we can rely on its Sharpe ratio. So the Sharpe ratio is developed by Professor William Sharpe. He has won the Nobel Prize in Economics in 1990 for his contribution to investment and portfolio management. So the Sharpe ratio measures the reward to risk. It's quite straightforward, measured by the ratio between the annual access return and the annual risk level that the investors are taking. So in theory, the objective of asset allocation is to maximize the Sharpe ratio. So out of curiosity, I went to the website of Federal Reserve Economic Data and have downloaded the data for S&P 500 index representing equity, crude oil futures representing commodities, and several real estate indexes for some major countries in the world, including UAE, for the past 22 years to make a comparison. So after the analysis, UAE real estate index is having a Sharpe ratio of 48%, very close to 51% of Sharpe ratio from the US equity benchmark S&P 500 index. US equity market has performed a 8% annual risk premium over the past 22 years. WTI crude oil being the most volatile asset, and having a Sharpe ratio of only 24.5%. Real estate in China and Japan are having negative Sharpe ratios. Real estate in USA is having 0.25% annual excess return and with Sharpe ratio of only 6%. Real estate in UK having a Sharpe ratio of 57% seems very high, but has performed by only a 2.36% annual excess return. While the real estate in UAE and Hong Kong have similar level of risk and annual excess returns. So 4% annual excess return is roughly a 7 to 8% annual gross return averaged for the past 22 years. Those are including the global financial crisis, the oil price crash in 2014 and the COVID period. Moreover, from the view of portfolio management, the correlation of the UAE real estate index with other major real estate indexes and with the equity S&P 500 index and WTI crude oil futures are very low. Almost zero correlation with the real estate markets in US, China, and Japan. UAE real estate market has lower correlation with the crude oil futures, even lower than the correlation between US equity market and crude oil futures. So UAE real estate market has lower correlation with the crude oil futures as compared with the real estate markets in UK, Hong Kong, and Japan. The correlation between UAE real estate market and the crude oil futures is even lower than the correlation between the US equity market and the crude oil futures. So this is most interesting point because UAE is the oil-rich country. Most people might think that the oil price should have a big impact on the property market in UAE. But the historical data results are telling a different story. More about the driving factors of UAE real estate price, I will discuss in another episode called how three factors are shaping 5 tiers of markets in Dubai. That might give some more clarified explanation. So in general, just by looking at the Sharpe ratios and the correlation metrics, it seems that investing in UAE real estate can bring significant diversification benefits to the international investors. A portfolio combined with UAE real estate can achieve higher Sharpe ratios because the excess return of a portfolio is just the weighted sum of the excess returns from the risky assets in the portfolio, while the risk level of the portfolio can be significantly reduced due to the fact that the low correlation between the risky assets in the portfolio. So just from the results of analyzing passive benchmark indexes on country level, theoretically it makes much sense why the international institutional investors are investing in real estate in UAE. If you find a property consultant like me in UAE, I can advise you on property selection, and with my expertise, I can further bring you a positive, huge information ratio to your active investment to make your profit great again. Finally, let's talk a little bit about the features of real estate as an asset. So real estate as an asset has both features of an investment product and a consumption product. So the investment product features represented by rental income and the potential capital appreciation from which the property owners can get benefit. While the consumption product features can be identified from 3 levels of demands. First, satisfying the living demands of households, which is basic demand and it's most price sensitive. The second is enjoying the views in certain locations if the occupant is on vacation. So this is kind of occasional demand driven by hedonic consumption, and it's not that sensitive to the price. The third is enjoying the feeling of status and the fulfillment of achieving success. This is a demand for esteem. So in this case, the higher the price, the better it makes the property more exclusive and unique. Well, starting from the basic demand, which is just living demand, most of expats in Dubai cannot afford a property in Dubai, so they will go for renting a flat instead. Obviously, for the long-term tenants, maybe the rental expense might be the biggest portion of their monthly consumption, and the price for such properties is most sensitive to the demand and supply equilibrium. From the economic point of view, paying the rent is considered as consumption, while buying a property is not considered as consumption. Maybe sometimes you might think that buying a property for end users can be also considered as a kind of prepaid expense for the rent and consumed through the lifetime of their stay. But the property owners can potentially sell out and cash out all their previous expense just by selling the property. So the price of the property is not included in the consumer price index, but only the rents are included in the CPI, which is a global consensus on reporting CPI data. And when we talk about CPI, we link it to inflation, because inflation measures the change in the weighted average of the basket of goods and the services, while the GDP can be also considered as the sum of the prices of all the goods and the services consumed within a year in some country or city. Therefore, GDP growth is the main driver of property price in most of the countries. So I would simply consider the real estate market cap to GDP ratio is the main indicator in the long run for the property price. Moreover, in practice, in most of the economic conditions, when the inflation is going up, the rent is also going up. So owning a property is a kind of hedging against inflation in certain sense. So those are the concepts to consider when analyzing the real estate price from the basic demand point of view. I would say so-called fundamental investing is earning the consumer's money at the end, right? So what do you think will happen to the property price in a place where the rents are very high and the rent is the biggest consumption for the most people, and they have to consume it without much effort from you to convince them? What do you think about Dubai, where the rental yield is 6% to 9% per annum? But when it comes to analyzing the property prices in Dubai, if you are only looking at the equilibrium between supply and demand, and think that only the residents are the main source of demand, then you are making major mistakes. Because you might ignore another two levels of demands: the demand for hedonic consumption and the demand for esteem. And Dubai is a location that can perfectly satisfy those two higher levels of demands. So it's important to sort out who should be your targeted customers if you come with a purpose to invest in UAE real estate. More about such content will be further discussed in the next episodes, called 3 Factors Are Shaping 5 Tiers of Markets in Dubai and Area Segments in Dubai. Now let's talk a little bit about the fair value of an asset. So the common formula for the theoretical value of an asset is simply described by discounting the future cash flows by a reasonable discount rate. So when valuing an equity, its a stream of stochastic cash flows are discounted by some stochastic discount rates and sum them up. And when valuing the debt, it's a promised stream of fixed cash flows are discounted by some stochastic discount rates and sum them up. And when it comes to valuing the real estate, it's kind of a debt instrument like cash flows, but its stochastic cash flows are discounted by some stochastic discount rates and sum them up. As Warren Buffett said, price is what you pay and the value is what you get. So it's crucial to understand what are the key drivers of those cash flows of rental income and capital appreciation, the possible terminal value when the investors exit. If the cash flows are driven by basic demand, then you might get a good, stable rental income, but very less chance for capital appreciation, or even sometimes slightly lost on capital. If the cash flows are driven by the demand for hedonic consumption, then you can get a nice rental income and a great potential for capital appreciation as well. If you are targeting the customers who are driven by the demand for esteem, this is super luxury properties. The price of such properties are not driven by any cash flows of expected rental income. But the potential exit value might surprise you. And delivering the payment plans, you might possibly double your initial investment during the 3 to 4 years construction period. So if you tell me your return objectives, I can advise you on property selection, which is specifically tailored to your investment goals. If you like the content and want to know more information, click the like button, subscribe to my channel, share this video with your friends, and you can WhatsApp me if you are looking to invest in real estate market in UAE.